There are approximately 2 million not-for-profit organizations in the United States employing between 12.5 to 13 million people, around 10% of the U.S. private sector employees. These organizations have over 75 million volunteers. Many of these people don't fully understand how the not-for-profit sector works, the governance, the finances, and the operations. Hi, my name is Joe Blatt, and I'm a certified public accountant. I've worked with not-for-profit organizations, their management team, and their boards for 40 years. Over my career, I've advised nonprofit organizations of all sizes, from small, community-based nonprofits to large, complex institutions. And I recently retired as a partner at Forbes Mazars, a top 10 accounting firm. I also serve on the board of Forestdale, a New York-based foster care agency. Welcome to Joe Talks Nonprofits, a podcast for people who want to better understand the finance and governance of nonprofit organizations. I created this podcast because I've seen the same challenges come up repeatedly throughout my career. Board members and nonprofit professionals are expected to make important business decisions about budgeting, oversight, compliance, and strategy, but don't have a full understanding of the nonprofit sector. The question I'm asked most is, where can I go to learn more about the ins and outs of the nonprofit industry, how a nonprofit works, and what the rules they need to follow? This podcast is designed to fill that gap. You don't need an accounting background to follow this podcast. My goal is to explain concepts in plain English, focus on what matters, why it matters, and what questions you should feel comfortable asking. By the end of today's episode, you should understand what makes a not-for-profit organization fundamentally different from other organizations, why governance and finance are inseparable in the nonprofit world, and how regulators, donors, and the public hold nonprofits accountable. Future episodes will go deeper into topics like not-for-profit financial statements, the IRS Form 990, contributions, endowments, internal controls, audits, and board responsibilities. If you find this episode helpful, please subscribe. New episodes will build on each other so that the first one set the foundation. Let's start with the most basic question. What makes a not-for-profit organization different from every other type of organization? In the for-profit world, the goal is simple: to generate profits for the owners. Those owners might be shareholders, partners, or individuals, whether it's a publicly traded company or a local candy store down the block. The financial statements ultimately answer one question: how much value is being created for the owners? Nonprofit organizations are fundamentally different. Nonprofits have no owners. There's no one who's taking the profits out of the organization. Instead, nonprofits exist to advance a mission. They serve the community, a cause, or a public purpose. If a nonprofit generates a surplus, the surplus stays in the organization and needs to be used to further the organization's mission. The difference has a ripple effect across everything a non-for-profit organization does. In the for-profit business, the difference between the assets and the liabilities of the organization is called equity. It's the owner's claim on the business. In a not-for-profit, that's different. It's called net assets because there is no ownership equity. And this leads to an important concept. Because nonprofit organizations have no owners, they operate under what's known as public trust. Donors, regulators, beneficiaries, and the general public are effectively the stakeholders. That's why transparency, governance, and accountability play such an important role in the not-for-profit sector. Nonprofits still need to operate effectively and responsibly. They still need good management and good governance, strong financial controls, but their success is not measured by profit. It's measured by how responsibly they use the resources to advance their mission. All nonprofits need to have the resources, though, to pay their bills. And as such, they need to have positive net assets. So essentially, they still do need to have a surplus or make a profit. Let's talk a little bit about board governance. Every not-for-profit is governed by a board of directors or a board of trustees. The board has a fiduciary responsibility to the organization. When we talk about fiduciary responsibility, we're really talking about three key core duties: the duty of care, showing up informed, asking questions, and exercising good judgment; the duty of loyalty, acting in the best interest of the organization and not in the board member's personal interests, and the duty of obedience, staying true to the organization's mission and its governing documents. We'll unpack these duties in more detail in future episodes, but for now, think of board service as oversight, not management. Board members hire and oversee key management. They approve the budgets, they monitor the financial health of the organization, and they ensure the organization is operating both legally and ethically. Even though board members are made up mostly of volunteers, they need to oversee management and not the other way around. As a board member, for you to be effective, you need to be comfortable questioning management's plan and disagreeing when appropriate. Think of a nonprofit the same way as you would think of your own personal business. Don't be passive. Board members have a great deal of influence over nonprofit organizations they serve. This influence is exactly why regulators impose safeguards. These safeguards are not to discourage service, but to protect the organization and the public trust. These safeguards can include conflict of interest policies, related party disclosure requirements, oversight of executive compensation, and limits of self-dealing. Each year, it's best practice for each board member and key management to sign a conflict of interest statement. This statement discloses any interest they have in the organization, directly or indirectly through companies they or their family are associated with. Anytime a nonprofit enters into a business relationship involving a board member or a board member's company or board member's family member, should consider consulting legal counsel. These situations are highly regulated and mistakes can be costly. Think of it this way. Let's say you're a board member at a not-for-profit organization and the nonprofit organization needs insurance. If in your day job you're an insurance broker, if you were to offer your services to a nonprofit organization at a fee, this would be considered a conflict of interest, since you have influence over management. Any payments made to you would need to be disclosed both to the IRS as part of the Form 990 and through the audited financial statements. We'll go into more details on this in future episodes. Another common scenario is a job opens up at a nonprofit and a child or a close relative of a board member applies for the position. Management may feel an obligation or a bias towards this candidate over others, and therefore this decision needs more scrutiny. Let's talk a little bit about how not-for-profit organizations earn their revenues. There are two basic types of nonprofit organizations that we're going to be covering. The first are those funded primarily by contributions, and the second are those funded primarily by program or service revenues. We'll start with going through those that receive their funds from contributions. And contributions generally are the lifeblood of most nonprofit organizations. They come in from individuals, foundations, corporations, special events, online giving, and other various sources. Most donations that come into these organizations are unrestricted, meaning that the organization can decide how best to use these funds. However, some donors, especially the larger donors, tend to add either a restriction or a condition to their gifts. For example, if a donor may give $10,000 for an organization to purchase a 3D printer, or a donor may establish an endowment fund for financial aid, or a donor may pledge matching funds contingent on future fundraising events. Restricted funds need to be tracked separately and spent in accordance with the donor's intent. From a board perspective, this is not an accounting issue. Spending restricted funds improperly can damage donor relations, trigger regulatory scrutiny, or create legal exposure. Contingent contributions are different from restricted contributions. A contingent contribution depends on a future event occurring before the organization is entitled to the monies. For example, matching funds. Think of these contributions that contain an if in a sentence. If you raise $100,000, I will give you $10,000. Or if you get financing to build a new building, I will donate $1 million. We'll cover the accounting for these transactions in the next episode. But for now, the key takeaway here is not-for-profits have a fiduciary responsibility to track donor funds and use them as intended. Another valuable form of contributions to nonprofit organizations is their volunteer services. Some nonprofit organizations are better than others in utilizing these services. Volunteer fire departments and ambulance companies would not exist without them. Schools use Parents Association regularly to do their fundraising and advocacy. Volunteers can also provide expertise in areas such as accounting, legal, teaching, and independent contractors. Accounting for volunteer services can be complicated, and we'll also address those in future episodes. For now, the key takeaway is that even though there is no cash changing hands, we need to track and monitor the use of volunteers. Using volunteers well can make or break a nonprofit organization. Nonprofits also may receive non-cash contributions such as stock, cryptocurrency, real estate vehicles, arts, and equipment. How these gifts are handled is typically governed by an organization's gift acceptance policy. This policy helps the organization decide what types of gifts it will accept, how these gifts are going to be valued, and whether and when these assets end up getting sold. As a board member, you should make sure your organization has a clear gift acceptance policy, and you should understand it. Not having a clear gift acceptance policy can result in some expensive errors being made by staff. Setting policy up front is much better than second guessing after the fact. As a member of the accounting team, if you don't have a gift acceptance policy, you should work on one with your fundraising department as well as your board. Make sure it's comprehensive and updated. We'll go into that in more detail as we go into some future episodes. Let's go back a step and define what is a contribution. So a contribution is a non-reciprocal transaction. What does that really mean? It means that the nonprofit is getting something from you without you getting anything back in return. It's completely one-sided transaction. There are some transactions which have characteristics of a contribution and characteristics of an exchange transaction. Two of these are special events and government grants, and we'll go into those next. So we talk about special events. We're talking about galas, luncheons, auctions, bake sales, things that not-for-profit organizations do to raise some extra money from the community. I'm sure many of you have received invitations to these type of events from friends and families. These events often include what's called quid quo pro transactions, meaning that the donor receives something in value in return for their payment, but it's not generally at fair value. For example, a $200 ticket to a gala where the dinner in a similar situation would be $75, or an auction item for a $100 gift card that auctions off for $200. In these situations, only part of the payments qualify as a charitable contribution. The rest consists of an exchange transaction. These transactions have specific reporting and disclosure requirements, which we'll cover in later episodes. For now, just know that there is higher scrutiny by the IRS and others over these types of transactions, and we need to be clear with the buyer what portion of the payment is tax deductible. Being silent can cost the nonprofit organization money and impact donor relations. Let's talk about government funding now. The federal, state, and local governments frequently use nonprofit organizations to carry out their mission. They do this through government grants and government contracts. These government grants fund programs such as homeless shelters, charter schools, and senior centers. Government grants are not free money. They come with detailed reporting requirements, conditions, cost allocation rules, and audit obligations. If a nonprofit fails to comply, the government can require funds to be returned, even if they already been spent. If a nonprofit fails to comply, the government can request these funds be returned, even if they've already been spent. Boards should understand that government funding requires strong internal controls and clear documentation. Weak systems create long-term risk. I've seen government agencies audit funds 5 or 6 years after the program has been completed, after employees that worked on the program are no longer employed by the organization. Lacking clear documentation can be extremely costly. The other type of nonprofit organizations are those that are funded by program revenue. These organizations receive payments for their services from their customers. These are purely exchange transactions. Think of an independent school, university, hospital, or a clinic. From the outside, some people don't even know that these businesses are nonprofit organizations. So what makes them nonprofit organizations? In most cases, these nonprofits are filling a real community need, one that probably wouldn't be met if they didn't exist. Often for-profit businesses just can't make the numbers work, either because the margins are too thin or the risk is too high compared to the return. That's why these nonprofits typically also require some level of contributions to fund the difference. Two good examples of these are universities and hospitals. Universities will generally provide financial aid to students who can't afford to pay their full tuition, and hospitals will not turn away patients who don't have insurance or money to pay for their services. There are many types of organizations the IRS classifies as not-for-profit organizations under Section 501(c) of the Internal Revenue Code. But for today, we're going to focus on charitable organizations, which fall under Section 501(c)(3). These organizations are exempt from federal income tax as long as their activities and revenues are closely tied to the charitable mission. This is a complex area of the law, and today we're just going to scratch the surface. We'll take a deeper dive in future episodes. The most important takeaway is that just because you're a nonprofit organization, it doesn't necessarily mean all the revenues you generate are exempt from taxation. Whenever you go into a new program or have new revenue sources, always ask yourself, is this part of our mission? If not, you need to do your homework to see if these revenues you are generating are taxable. We'll have a separate podcast on unrelated business income in the future. Nonprofit organizations are also governed by states and cities they reside in and solicit in. Each state has different rules and regulations as it relates to nonprofit organizations. So you need to register and file informational returns in each state you are actively soliciting contributions, employing staff, or have a physical presence. I have seen organizations get into trouble as they expand and hold events or hire staff in new locations and not register with the state. As we mentioned earlier, nonprofits operate on public trust. As such, they operate in a highly transparent environment. Nonprofits have to answer to regulators, donors, watchdog agencies, as well as the general public. Every year, most nonprofits, with the exception of certain religious organizations, are required to file an informational return with the IRS, commonly called the IRS Form 990. The reason it's referred to as an informational return rather than as a tax return is it covers a lot more information about your organization's operations than a tax return. And as we mentioned earlier, most revenues earned by nonprofits are not subject to tax. This return can easily run 40 to 50 pages long. The form includes not only the revenues and expenses of the organization, but a lot of governance-related questions and details about the organization's missions and accomplishments. The Form 990 is a public document and as such can be accessed on the internet as well as at the organization itself. Organizations such as Charity Navigator and Candide analyze these filings and make them widely available. It's not uncommon for reporters to read the Form 990 and report executive compensation levels in their news articles. Board members should review the organization's 990 annually before their file. Remember, this is not just a tax form, but a public-facing document that reflects the organization's governance and stewardship. Asking questions about the 990 is not micromanagement, it's good governance. Some key takeaways: if you're a board member, make sure you understand your organization's programs and funding sources. Understand who prepares the 990. Ask to see copies of key policies, including conflict of interest policies, as well as gift acceptance policies. Remember that governance and oversight is your responsibility. If you work in the finance and accounting departments, maintain clear written policies and procedures. Keep the board and finance committee informed. Seek continuing education, specifically in the not-for-profit industry, and use your audit and finance committee as a key resource. Nonprofits play a critical role in our community, from healthcare to education to social services and houses of worship. With this comes responsibility, transparency, and accountability. This session only scratched the surface on how nonprofits work. Future episodes will go deeper and deeper into the important topics on governance and finance. If you have ideas of topics you want to hear, please feel free to add them to the comments. And if you found this session helpful, please subscribe to my podcast, Joe Talks Nonprofits. This is the first in many on this topic. This podcast is intended for general informational educational purposes only. It does not constitute accounting, tax, legal, or other professional advice, and should not be relied upon as such. Laws, regulations, and accounting standards change frequently, and their applications can vary widely based on specific facts and circumstances. Accordingly, listeners should consult with qualified professional advisors regarding their individual situation before taking any action. Thank you for listening, and I'll see you next time.